Tell us about analyzing a deal. One of the things I did when I got into this business back in 2004, I mean, I was in the real estate business before that, but
Hmm.
strictly the investment side of the real estate business starting in 2004. One of the things I did is I standardized the data, and I think that was a
Right.
really good decision because I found it so frustrating. Here I am, I'm researching like crazy. I'm researching all these different markets around the country. I'm flying to these markets. I'm meeting with people. I couldn't get any help. It was just the people you deal with in real estate. It's just a totally mixed bag. I'm sure you know
Right.
that.
Yeah, absolutely.
And most real estate people, they don't know anything about investing. They just sell houses, right? And so I found a software called Property Tracker
Hmm.
back in 2004, and I started using that, and I loved it. And I just standardized the data. You got to have a benchmark. You got to standardize the way you analyze things, so that you don't have to be a detective on every property. So tell us about analyzing properties, and what investors should look for, and what they should watch out for too.
Yeah, I'll kind of keep this. Obviously, there's a lot of different deals and different investors, be that multifamily, single family, renters, those who want to buy rental properties or flippers will look at different numbers. But there's a few kind of common factors that I see over and over again that I love to point out. The first one is, no matter what tool or calculator or Excel spreadsheet you're ultimately using, it's only as good as the actual input numbers that you provide. And a lot of times, especially out-of-state investors, they use very kind of crude or basically unresearched estimates, in my opinion, to plug into their calculator. And in my experience, if you kind of put garbage in, garbage out, so to speak, if you use inaccurate projections, extremely rough projections, or numbers to input into your calculations, you're going to get very, very rough or
Right.
inaccurate
Yeah.
projections out. So
And a
I
lot of it is just wishful thinking.
absolutely. I mean,
Yeah.
at that point, you're kind of guessing. If you can't justify why I'm putting 10% for vacancy or 12% for maintenance, the numbers you get are really just guesses. And that to me is the key. And the only really sure way I found to start putting accurate numbers in your cash flow or profit projections for flips is to really know the local area, either personally or by knowing other investors
Hmm.
who live there, who invest there. Maybe property brokers or agents, like you said, although they can be hit and miss. But that's really comes as a key. Every time I go in a new market, a new property type, a new area, I first spend a considerable amount of time learning the area. Looking at dozens of properties, speaking with other investors in the area to get more accurate idea of, okay, what are my typical vacancies are going to be, what is my typical rent going to be, what ages are the properties there, and kind of derive the potential maintenance or capital expenditure costs from that. So,
Hmm.
that's kind of always been my biggest pet peeve is spend, you hear a lot of investors use like the 50% rule, for example, to quickly estimate expenses. And, maybe it's great for doing a very rough analysis, but in my opinion, it falls very short if
Hmm.
you're actually serious about buying a property. So you absolutely have to, look up rent comps to get accurate rent. You have to look at other properties maybe another investors own to look up vacancy and so forth. So really, you need to use accurate, as accurate as estimates or projections or actual numbers, that you can,
Okay,
and
so
and
so
that is
there's two sides of this then. There's the input data, the data you put,
absolutely,
but like the old saying in the computer world, right? GIGO, garbage in, garbage out,
yeah,
right? So you got to get the right input data, but then using the tool and knowing what to look at, what to value and what not to value so much, right? For example, I'm not a big fan of cap rate. I don't think that's a
yeah,
very good metric. Yet in commercial real estate, you talk to any commercial person, and they live and die by cap rates. But it leaves a lot out that is very attractive for residential income properties. Uh,
absolutely,
so that's the thing, and people miss a lot of stuff in the income property world because what I've said for a long time is some people are winning but they think they're losing just because they simply don't know how to keep score properly, you know? And you have these multidimensional aspects to a real estate deal where, you know, it's kind of like the old metaphor of the iceberg, right? A lot of it's under the water and you don't really see it. You see the cash flow or the negative cash flow. Hopefully you don't have that.
Exactly.
But you don't really see some of the things that are really adding to your return and making your investment a lot better than you think, you know? So yeah, what to value, how with the input data, talk to us about that a little bit.
Absolutely. So after the input data is accurate, like you said, you need to figure out what metrics to focus on. And it can be overwhelming for a new investor. You know, you go to a typical calculator or online, people talk about probably at least a dozen, you know, common metrics. You know,
Right.
we're talking cap rate, cash on cash return, ROE, you know, return on equity, return on investment, annualized return on investment. So ultimately, I very much agree with you, Jason. You have to pick a few metrics to focus on, but not because they're popular. You know, I fully actually agree with you about cap rates, especially in residential real estate. It's a very popular metric. In my opinion, it's somewhat
It
misleading
misses.
and
Yeah, it really
yeah,
is
and
quite
and it's
misleading.
not
Yeah.
very useful.
Hmm.
So, you know, there's two things in my opinion to that. One is really understanding what the metrics are and how they're calculated. You know, you can look that up online in a few seconds or read a few articles. At least understand what a cap rate is, what is a cash on cash return, what are the underlying numbers. And two is look at your goals. You know, what are the goals of you of purchasing the property, and find the metrics that align with those goals. So in my view, my primary goal is cash flow. So for any deal, actually the first two metrics that I focus on is cash flow per unit per month and cash on cash return.
Hmm.
So the reason I focus on those two is first, obviously, you know, my goal of 50 units with about $200-300 monthly cash flow. To me, that takes me to about 150, 200,000 in yearly cash flow, and that's really my ultimate goal. You know, my primary goal for real estate is to replace my W-2 income, allow me to retire early. So naturally, that's the first metric I focus on. The reason I focus on cash return because cash flow by itself can be misleading. You know, I can spend $500,000 on a property and get $200 a month cash flow, or I can spend $50,000 on the property and get the same cash flow per month. Which one is the better deal? Obviously, the one I spent less money on because,
Yeah.
you know, and the
Or
cash on cash return.
or even better, the one you put less money into, meaning you've
Correct.
got more
Exactly.
leverage, which increases your cash on cash return, right?
Exactly.
Yeah.
So and that's my second metric, the cash on cash return. Like you said, the way you structure the deal, you know, the price of the property and your ability to bring as little cash to it as possible will increase that return
Hmm.
and really allow your money to work for you in the greatest possible sense. And then the final, you know, if I had to pick my top three metrics, I actually focus on annualized ROI. So this is
Hmm.
sometimes internal rate of return. And this is, in my opinion, the most all-encompassing metric that takes
IRR
into
is.
correct that
Yeah, I
takes into
agree.
account
That's the
uh,
holy grail of metrics,
correct.
internal rate of return, and it's hard to calculate. But now we've got all these tools that make it easy.
Yeah, and that one really allows you so now not only cash flow but take into effect projected price appreciation and debt pay down,
Hmm.
and basically give you a total rate of return
Right.
on your invested capital that you're getting. And that's really the only metric you can also compare to, say, you know, the stock market or other investment types because it's all encompassing. And
Right.
and you know it's you know it does take into account some assumptions like obviously appreciation, which is very hard to predict,
Hmm.
and that's one of the reasons why I don't focus on that primarily, but kind of as a third metric to give me, hey, you know, cash on this property, cash flow is great, cash on cash return is great. Let's look at IRR, my total return on investment, and you know that can be used to compare, for example, different properties between each other, or even real estate to other investment sources, and really decide, hey, am I putting my money to the best use?